Hey everybody, this is Jason Matthews, your financial guru. This is the third part of our series talking about life insurance. And part of any financial plan, the basic thing is life insurance. It's the foundation. We could talk about all the sexy things about investments, stocks, gold, ETFs. But if we don't talk about life insurance, all that stuff doesn't matter. And if you talk to any financial planner, your basis is always going to be your life insurance and your foundation for it. So the reason now with part 3, we're really going to talk about the types of life insurance there are. There's a lot of different names for life insurance. There's whole life, there's universal life, there's term, there's variable life, universal, there's return of premium. But there's basically two types of life insurance. The first type of life insurance is term insurance. How term life insurance works is you pay a flat rate for a certain amount of time. It covers you for 10, 20, or even 30 years, where you pay the same premiums for 10 or 20 or 30 years. After that, the rates go up on an annual basis. So let me give you an example. Let's say you're paying $100 a month into life insurance. After 20 or 30 years, those monthly premiums could jump up to $700 a month. Now, a lot of times this is for if you have a term or temporary. Term means temporary insurance issue. For instance, you just want enough insurance to cover your mortgage until you're paid off. Maybe it's to take care of the kids until they're a grown adult and they can be self-sufficient. So that's why we have term insurance. The good thing about term insurance, we can buy a whole lot of insurance and it's cheap. Now, the money you put into it, you cannot get back for term insurance unless you add something like a rider, like a return of premium. But the money you put in, the money you lose if you don't use it. Only 2 to 3% of the time, people ever use the benefit. But the good thing is we have coverage if something happens towards us. The second type of insurance is permanent insurance. Now, permanent insurance, there's about 3 different types of permanent insurance. There's universal life, there's whole life, and then there's variable universal life. And there's a fourth one that's getting a lot of popularity, which is index universal life. But they all pretty much work the same basics as this. With perm insurance, you pay a flat rate for your whole life. Over a period of time, your death benefit goes up and your cash value goes up. Now, let me say this. The wealthiest people in organizations, banks, General Electric, Jack Welch, Bank of America, the wealthiest people in the biggest corporations in the world have the most permanent life insurance. The reason being is that the money that grows into these accounts grows tax deferred. And the money you put into these accounts, guess how it's taxed? It's tax free. So let me give you guys an example. Let's say we have a $500,000 life insurance policy that's permanent. In 20 years, the death benefit could be $1.2 million. The cash value, and the way that they get the cash value is your premiums plus in any type of way that it grows. And in 20 years, it could grow up to $750,000. Now, the $750,000 grow tax deferred, and the wealthiest people in the world use it. Why? Because you can pull out all the benefits tax free while they're living. While term insurance is only when you're dead. And the best way to say this is there's 2 types of parking lots is the best description of how we say this. There's parking lot A and there's parking lot B. Parking lot A is 50 cents a day. Parking lot B is $1 a day. The difference between parking lot A and parking lot B is in parking lot A, at the end of the month, we don't get any of our money back. While parking lot B, at the end of the month, we get all our money back plus interest. But you know what? Sometimes we don't have change in our pocket, or we give all our money to our wife or to our kids before we go to work, and we might not have the dollar for the day. The good thing about parking lot A compared to parking lot B is we can convert parking lot A to parking lot B within a certain time period. And it's based on insurance companies. They'll allow you to convert it within 10 or 20 years based off of no matter what your health changes. So as we get older, our health might be deteriorated, but they might allow us to switch over to permanent insurance with no question asked, allow us to go over to permanent insurance. Now, if you like this video, please give it a thumbs up. Hope this is helpful for you to understand all your life insurance needs. Have a great day. Talk to you later. Remember, make sure you share this if you like it. Good night.